Welcome back. Monday, the Commerce Department reported U.S. construction spending fell by the most in a year and a half in August. The drop of 0.7% in August was the largest decline since February of 2021. That was after decreasing 0.6% in July versus estimates of a decline of 0.3%. So, not good news coming out of the Commerce Department in terms of construction spending. We can see over here this is a 0.68% decline following a prior decline as well. And all of a sudden, the construction spending has very much turned to the downside. Taking a look at the chart, we can see here nice steady trend to the upside, but now turning south. The housing market, typically has been very strong over the past couple of years, but we're starting to see negative numbers replace the positive ones. Take a look at over here the housing active listings. That's a number of active listings. Now, this number continues to increase. Now, on the surface, it may sound like a good thing, but I think it's actually quite the opposite, because as investors, as home buyers pull away from the market, if they're maybe less inclined to buy something, then this number is going to go up. It shows us that the inventory is increasing, in part maybe because there's just less buyers out there in the market. Construction spending hitting a level over here at 178, 1278. Now, that is closer to its recent swing high, at least over the past 10 months, but certainly not a good sign that we're not making a new highs. Now, take a look at the housing active listings. That did make a new high. So while construction spending is falling, the number of active listings is increasing. This shows us increased supply, and when there's more supply than demand, then ultimately that will lead to lower prices in the market overall. Now, there's some pretty interesting correlations that exist with the housing active listings and the construction spending. If we take a look over here, this is construction spending, and then we move over to our active listings. We don't see a strong correlation, a 63% positive correlation. That reflects the most recent numbers, but I think as we see, if this trend continues, where the spending decreases and the listings increase, we're going to see this correlation kind of fall apart. Because, and we'll take a look at it from a graphical point of view, the blue histogram bars, that's a construction spending, nice steady trend to the upside. But again, this correlation, which I think once upon a time they were moving in the same direction, but now as construction spending wanes, we tend to see active listings increase. The same way that when construction spending was going up, when there was more and more money being spent in the housing industry, well, the active listings were going down. There just was not that much supply. Now we're seeing the opposite sort of dynamic take place, where there's more supply and less spending. Taking a look at the blue line, that represents our housing index. It's comprised of the home price index, existing home sales, active listings, construction spending, residential construction, etc. That's moved pretty sharply back to the downside. It's near within its, still within its trading range that we've seen for, the better part of a couple of years. But if we recall back to the 2008 level, this blue line hit a very big low. And that, I think, is really the difference between prior downturns in the market and prior, big time recessions, is that when we see the red line, that stands for the inflation index, and the green line, the growth index, those will oscillate and hit lows and highs pretty often. But when the blue line participates, that means that I believe that the overall economy is in a very recessionary point of view. Now, getting to the bond market, we know over the past several months, the dollar has been going ever so much higher. Bond yields have been going higher as the prices have going down, all in anticipation of the Federal Reserve continuing to raise interest rates to combat inflation. Over the past couple days, we've seen a reversal in that trend. Notice the yields on the short-term bonds that have been very, very strong, like the 1 year and the 2 year, are now negative. The yields even on the 7 year and the 10 year, which were also strong, are now negative. Now the 7 and the 10 year are selling off a lot more than the 1 and 2 are. And that shows us that capital is moving again into the longer term bonds and out of the shorter term bonds. Because as the yields go down, it means the prices of these bonds are actually going up. So when capital comes back to the bond market, it's been leaving for a long time. When it comes back to the bond market, there has not been a change. And I think this is really kind of the key. Over the past couple months, we see short-term bond yields go through the roof and long-term bond yields go up, but to a lesser extent. If the bond market turns and we see yields going down, we would expect, well, maybe the 1 and 2 year yields will go down more. But no, this is the same thing that's been happening. The dynamic hasn't changed. The inverted bond yield still remains, in the sense that the long-term bonds are absorbing the capital. Investors, traders, they still do not have any faith in the short-term future, and therefore they're not buying the short-term bonds. They're buying them a little bit more than they were 3 days ago, but they're still not buying them more than the long-term bonds. There's still a negative tone out there. The orange-yellow background chart, that's the S&P 500. Now, reversing to the upside, the green line represents the spreads of the short-term bonds. As stocks go down, this green line goes up. So conversely, the yield is coming down. There's a little bit of capital moving back into the short-term bonds. Notice we have a crossover. The long-term bonds are going back up. The yields, or the spreads, I should say, between the long-term bonds, between the 30 and the 20, and the 20 and the 10, those are going up. It's really the medium-term bonds, the spreads between the 5 and the 3, the 3 and the 2, those are the bonds that are really still contracting. And that's really not a good sign, because in a healthy market, we'd want to see the longer-term bonds like the blue line, those should be the highest. And that's certainly not the case. Top right-hand side, red line shows us the culmination of all the different bond yields, the 30-year bond plus a 20-year bond, etc. That was very much of the upside, now coming down, not coincidentally, but coinciding with the S&P 500 bouncing off the low. The question that everybody is asking is this a real reversal, or is this just a bounce? Interesting, the 30-20 spread has still a very strong correlation with the S&P 500. The S&P 500 is a black line, and the orange line represents a spread between the 30-20 bonds. So this correlation remains. Point being is, I don't think really anything material has changed. I think that this is a bounce in stocks. I think that this is a reversal, a short-term, maybe a short-lived reversal in the bonds. We always could be wrong, but the dynamic hasn't changed, that the traders and investors, they're still deferring to buy the longer term bonds. They're moving away from the shorter ones. On the left hand side of the chart, we have the blue line. That's the 10-year treasury bond. The yields were going up, up, up. Now a little bit down. But notice the mortgage rates are not declining. The 10-year bond is declining, but the mortgage industry, well, it's not really taking this reversal over the past 24 hours very seriously, in my opinion. And that mortgage spread, the mortgage spread, again, is a difference between the red line and the blue line. The difference between a 30-year average mortgage and the 10-year U.S. Treasury bond. The difference between that is known as a mortgage spread. The yellow line represents the mortgage spread. So that has really moved back to the upside, as the purple line, the S&P 500, has bounced off the bottom. But I don't necessarily believe that this is a good thing, because while the 10-year bond, maybe it's declining, it's still not cheaper to buy a house. It's getting a little bit relatively more expensive. The mortgage spread is not reversing as we would hope to make things cheaper the way that we would hope, as interest rates going up, and we're hoping, or the Federal Reserve, I should say, is hoping that will cool the economy. Doesn't look like it's cooling the mortgage markets. Now, getting to a little bit of technical analysis, we have the S&P 500. The blue line represents a 20 moving average, and then we have the Bollinger Bands below and above. And we see a reversal back inside the Bollinger Bands and the 20 moving average. Now, looking to trade in the same direction as this overall trend to the downside, I think traders are really going to look to see if the S&P 500 can maybe retest that 4,200 level, that's the 20 simple moving average. In a downtrending market, we tend to see the market remain between the 20 simple moving average and the lower band, or in an uptrending market between the center moving average and the upper band. So I don't necessarily think that we're going to skyrocket higher. I think that perhaps, we could test the 20 simple moving average. And conversely, as the S&P 500 goes up, we see the VIX, the volatility index, go down. The VIX is comprised of the premiums on the near-term option contracts on the S&P 500. That's the red line. And as we saw in the prior chart, as the S&P 500 bounces off the bottom, the VIX is bouncing down from its top. But we see that the Bollinger Bands still continue to expand. And that expansion, and we noted this a couple videos ago, the expansion in these Bollinger Bands usually forecasts that we're going to have a big volatility move in the future. So it'll be very interesting to see. What traders really will do is they'll look to see historically how markets have behaved at different VIX levels, meaning that the VIX right now is just around the 30 level, maybe a little bit below at this point. Historically, how much does the market sell off when the VIX goes down to 30? And how much does the market sell off if the VIX is able to get to 35 or 40? Those historically are actually very big levels. We actually put together a survey. We looked at years and years of historical data, seeing exactly how the stock market behaved when the VIX was at specific levels. We'll put a link here. If you have a chance, take a look at that link, at that video, because that really gives a much better picture and gives us a better understanding of how we may expect markets to behave if the VIX pulls back to the 25 level, or if we rocket higher and maybe we hit 35 or 40. We hope this has been helpful. We look forward to seeing you back soon.